Hello, everyone. Welcome to the final bar. Today, we're going to do our normal Friday routine. We're going to wrap the week. Look at how the markets have evolved from last Friday to this Friday. I tell you how the markets have evolved. They've evolved to the upside and not the downside. You're seeing stocks broadly breaking out with the S&P and the NASDAQ making new all-time highs this week. We're going to look at those charts, but also some signs of internal weakness with breadth measures that are less than ideal, advanced decliners not breaking out to new highs yet. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday as we break down the markets after the close, focus on the message that the markets themselves provide as we indicate or understand the indications of price, breadth, and sentiment by looking at a bunch of charts together. Hopefully what we do on this show helps supplement what you're doing in your own practice, analyzing the markets, using stock charts to make sense of market dynamics, focus on following trends and anticipating trend reversals. As I mentioned in the introduction, what we've seen this week and what we've seen today is a continued push to the upside for stocks, the S&P, the NASDAQ making new all-time highs this week. You did not see new all-time highs in some of the other indexes, which is a little noteworthy. Today, for example, as the S&P pushing higher, you had technology actually a little bit down for the day, not by much, but a little bit down when the S&P was up about 1/3%. The leadership today actually from more defensive sectors. After financials, you had utilities, consumer staples, and real estate leading the way higher. So sort of an interesting Friday, not sort of a, all is well, everything's good, long and strong sort of signal. It was a bit of a mixed signal, right? And I think the other thing we're going to look at are some of the breadth indications as we get to the Mindful Investor Live chart list here in a little bit. Coming up on Stock Charts TV next week, particularly this show, The Final Bar, we have a couple guests to tell you about. On Tuesday, June 29th, Clint Cowles from TD Ameritrade coming on the show. On Thursday, July 1st, Grayson Rose from here at StockCharts.com. Grayson has really led the development on a lot of the really fantastic features on Stock Charts recently, including the new ACP platform. He's going to share with you some of the tools he uses as he's analyzing the markets himself. We have a couple days off next week. Wednesday, June 30th, we'll have no live show. And then on Friday, July 2nd, we'll be taking the Friday off before the long holiday weekend. The week after that, starting on Tuesday, July 6th, this show will be moving to 4 p.m. Eastern live every weekday. We're getting back set up with a live broadcast from our studios here in Redmond. We're going to have our guests on camera, which we're super excited to update the look and feel of this show. So a lot of really good things to come on the Final Bar and also elsewhere on Stock Charts TV. Let's get to our Wrap the Week segment. This is our normal Friday segment to try to look at how the markets have evolved week to week. And I've been hearing from a number of you. I know many of you watch this show live as we're broadcasting it on Friday evening, but many of you watch over the weekend. And I would encourage you that to hopefully have a time over the weekend, whether it's Friday, Monday, whatever, somewhere in between, a time to analyze the charts and how they've evolved. And hopefully the show can help you do it. We asked you on a poll recently, what would you feel most comfortable shorting right now? It's a perfect segue into our Wrap the Week segment. Your choices were stocks, bonds, gold, or Bitcoin. The votes are in, and 45% of you said Bitcoin as the far outweighing the other ones. The other pretty much split between stocks, bonds, and gold. I'm not super surprised because if you look at the charts, if you have those four charts, the SPY, the TLT, the GLD, and Bitcoin, $ BTC USD, one of those four certainly looks the weakest. Bitcoin certainly, showing a lot of volatility, but testing key support after having come down so much and losing, 50% of its value. Gold and bonds on a relative basis, a little weaker than stocks for sure. And you've seen some rollover in precious metals this week. But overall, I can't disagree. I did not answer the question, but if I did, I would most likely say Bitcoin as well. And it's important to remember on a question like that as we go to our Wrap the Week segment. Just because you would feel shorting it, I don't know if I would feel lifetime short Bitcoin. I think overall, Bitcoin could certainly be much higher than it is today. The whole implication of the blockchain and technology and where it's going to hit other places. There could be other coins that far outperform Bitcoin over the long term. So I don't think it's the idea is there, but it certainly had been frothy and certainly coming down to earth. And I don't believe that that's done based on my analysis of the charts. Let's wrap the week very quickly. Look at what's happened today. We're going to focus on the weekly returns, and then we'll get to the Mindful Investor Live chart list. To summarize today, market drifting higher is how I would describe it, up 1/3% with the S&P closing just above 4280. Notably, the NASDAQ 100 was actually down today, down just about 1%. So not much, but certainly underperforming. Mid caps far outperforming the rest of the bunch, up 0.9%. Very quickly with other asset classes, you have yields going higher today. So if you're wondering why financials are at the top of the list today, this chart most likely explains that. That's a big tailwind to the performance of financials. If yields are going back up, they were up below or just below 1.5% yesterday, and now closing the week around 154 or so. The dollar, by the way, completely flat, just below 25, remaining where it was on the UUP. Gold and precious metals up a little bit today. So you had the GLD up 0.3%, but that's really the pattern that we've seen in gold over the last couple of days. You can see these little the little preview charts gapping up in the open, but then spending most of the day going down. Today was actually unique. The last 4 days, pretty much every day has closed near the lows. Today we actually popped up a little bit going into the to the close, but overall relatively weak. And commodities as a whole down today. Cryptocurrencies continuing to feel the weakness, with Bitcoin now back down around 32,000. This is down from around 34,000, almost 35,000 at the close yesterday. So certainly continuing to show weakness. And again, I don't, while the strength or weakness of an individual day has a lot of different factors, I would say the overall overarching trend in Bitcoin has been down, and I'm not surprised that days like this continue to happen. I think there's further weakness to be had there, and 30,000 for me is sort of that line in the sand on the chart of Bitcoin. Very quickly with sectors, as I mentioned, it was financials, then a lot of defensive leadership like utilities, consumer staples, and real estate. That is a very different look at the top of the list than we've seen in a while. At the bottom, you have some of the growth sectors that have done the best recently: technology and communication services, two of the bottom three sectors. Let's quickly look at the wrap the week chart. So this is our chart looking at the returns from last Friday to where we're at today, just after the close Eastern. Here's the S&P up 2.8% for the week here in black. What underperformed the S&P? Most things, actually. So emerging markets were up 2.4%. Here in purple, we have the NASDAQ 100 that was up 2.1% this week. Gold here, 1% for the week. The rest were down on the week. You have the dollar using the UUP as a proxy for that, down 0.5%. And then here we have bond prices down 2.6%. A couple things actually outperformed stocks this week. And in brown, we have crude oil up 3.9%. And then finally, small caps up 4.4. So out of this entire group, small caps were the leader. And even though they underperformed the S&P today, just up a little bit above the zero level today, overall for the week, small caps certainly outperforming large caps by a decent gap there. If you look at about a 1.6% difference from the Russell 2000 to the S&P this week. If we add Bitcoin in there, just if you're looking at cryptocurrencies, certainly weaker and down 10.3% for the week. And again, not as bad yesterday. Today sort of gave a lot of it up. So Monday and Friday really accelerating to the downside. You had a couple sort of recovery days in the middle there, but that sort of pattern with an acceleration moves to the downside and then a bit of recovery moves on the way up is really characteristic of a downtrend, which is, again, what I would argue a lot of those cryptocurrencies are sort of in right now. Let's complete our Wrap the Week segment looking at the Mindful Investor Live chart list. If you've not seen the show on a Friday before, the way you get to this, by the way, is go to StockCharts, go to the top where it says Articles. Click on that, go to the upper right where it has all of the StockCharts blogs, and go to my page, which is called the Mindful Investor. You're going to get to this page, which is sort of my homepage for all of my content, and you'll see live chart lists at the top, little gray button. That'll get you right to the list that we're going to look at together right now. We're going to start with a weekly chart of the S&P using what I call the market trend model. This is a model I developed years ago. It is a a very simplistic trend following model, but I've found over my career, simple tends to mean better. More complex usually means it can interpret a particular market or a particular set of circumstances probably more effectively. But if we really want to understand things consistently over time and have a model that adapts to changing variables, which I would argue the markets are always in a period of flux, then you want something more simple. More simple usually means more robust, which means it's going to work better as the variables change. And so I have a simple trend following model using weekly moving averages. Overall, here's what it's saying. The long-term model has been positive since last June. So now we're hitting a year, just over a year in bullish territory. That turned positive a couple months after the March the March 2020 low, turned positive about in June and has remained positive since then. The medium-term model for me turned negative in May, about 5 weeks ago. It's turned negative 3 times since that March 2020 low. The first time was in October of 2020, the second time in February of 2021, the third time about a month ago in May of 2021. Now, in both of those previous times that I mentioned, about 2 to 6 weeks later, the model turned back positive. And so it basically turned negative in the corrective period, would turn more positive as we would go back to new highs. It's interesting that the model has not turned to new highs yet, even though we're at all-time highs in price. And that still doesn't bother me. I think for me, that medium-term model for me is more risk on or risk off, and maybe more to the point, helps me to decide whether to focus more on potential reward or focus more on potential risk. The fact that it remains bearish here tells me to just keep focusing on risk potential. For charts that are working, there's no reason to sell them in this sort of scenario. It tells you to focus on lines in the sand, or as my former flight instructor used to say, when you're flying straight and level and everything is going well, that's the time to develop your emergency plan. That's how I would think of this here. This is telling you the conditions are similar to what we've seen at other topping patterns. So it's not telling you we're definitely going to go down, but it's telling you to focus more on the potential breakdown opportunities. Finally, we have the short-term model turning back bullish in the last week, and it turned negative as the market pulled back last week, back positive. Excuse me, and that's very simply looking at where we're at relative to the 5-week exponential moving average. Overall, telling you that in the short term, the tactical read, the conditions are positive. The daily chart of the S&P we've looked at most days this week on the show. And, again, I'm seeing a very consistent pattern with the S&P having impulse moves to the upside, having pullbacks to the 50-day moving average. That has happened so many times year to date. That's sort of the assumption, I think, from here on out. You expect pullbacks to the 50-day, and so far, 100% of the time, the market has repelled any attempt to break down through the 50-day moving average. I'm inclined to assume that that sort of trend is going to continue until proven otherwise. So new all-time highs today and this week, certainly positive. The fact that the market, the S&P remains above its 50-day on pullbacks is certainly encouraging. Let's get to the less encouraging stuff. Example 1 is on this chart. We have a pattern right now, which is the same pattern we had in Q1 of 2021. The market making new all-time highs in April. But then every month after that, you continue to make new highs. But every time we make new highs, it's on lower momentum. That's called a bearish momentum divergence. It does not tell you the market is definitely going to go lower, but it's certainly what a top will tend to look like, right? An incline in price and a decline in the momentum. You certainly saw that here in the first quarter, right? January, February, March of 2021. That did not result to the downside, obviously. And I tell you, when that cleared was when you broke to the upside. You had new highs in the S&P, and it was no longer a bearish divergence. The RSI actually made new swing highs as well. We've not quite had that. So today, even with the new high this week, the momentum is lower than it was earlier in June. So that is a chart I will definitely be watching, and a signal I'll certainly be watching for next week. Some of these breadth indicators, including the ones we're going to look at here, aren't updated yet for today's close. It certainly could change the character, but something I was looking at going into the close today is whether or not the cumulative advanced decline lines would confirm this week's new all-time high. So what happened, if you look back in March, if you look back in April, and before that, the S&P going to new all-time highs, the cumulative advanced decline lines all going to new all-time highs as well. This is when I turn these all back to green, particularly here, because the small cap index actually took a while to confirm the new high, but it finally did. And here in early May, you see all of these in the green, indicating that price is going higher and the advanced decline lines are going higher as well. That is not the case right now. So on this week's new all-time high on the S&P, and the same for the NASDAQ, none of the cumulative advanced decline lines are making new highs right now. Now, again, while that might just resolve itself over the next week, if prices go higher and stocks continue to accumulate, these will all naturally go higher as well. But at this moment, you're seeing a new high that is not yet confirmed by new highs of the advanced decline list. Well, it's not like a bearish divergence or anything. It's probably lesser than that. Call it a non-confirmation, which is sort of the potential warning sign. It's something to watch. And again, this is a chart I think it will be very interesting to watch going forward. So, the breadth, not necessarily positive. It's more measured right now. One more to look at in terms of breadth. This is the percent of stocks above their 50-day moving average. We've looked at this chart before on the show pretty regularly. 90% of the S&P as of Thursday's close trading above their 200-day moving average. That's remained fairly elevated, above 80% from pretty much this entire year since the fourth quarter of last year. But if you look, only 47% as of Thursday's close of the S&P 500 were above their 50-day moving average. It was above 90% about 2 months ago, there in early April. And so in the last 2 months, you have a bunch of stocks that had been above their 50-day moving average that have not gotten back above them after breaking down, and that's a bit of a concern, right? A peer of mine on the Twitters, we're talking about how if you test back to the 2009 low, what happens every time that this indicator is above 90%, and pretty much every time. I think there was one example, maybe going back to 2009, where that happened, and the S&P wasn't higher 3 months later. And I don't know how much that validates that as a bearish signal. All that tells me is the only times you're going to get the indicator above 90% is during a bull market phase. That's what that tells. That's what that tells me. The fact that we're below 50% right now is a bit of a concern in my book. I'd much rather the market going to new highs, supported by increasing stocks going above their 50-day moving average. Sentiment we talked about yesterday, but overall bullish and not elevated. The last chart I want to look at before our break here is this one. This is looking at offense versus defense, consumer discretionary versus consumer staples. These were both very close to breaking down at the end of May. They did not do so. They did not make a new swing low, and now they've returned back to the upside, showing overall investors are more on the offensive side of the consumer space. We need to take a quick break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is your host, Dave Keller, here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show. We are excited to hear from you always. Feedback on the show, on our host, on our guests, but especially questions that are coming up as you're analyzing your own charts. We're here to help you along your charting journey. You can reach us via email, thefinalbar@StockCharts.com. That's the best way to get a hold of us. Other ways you can get questions to us via Twitter. We are on there at FinalBarSCTV. Just tag us in the comments. Also on our YouTube channel, put a comment below the video that you're watching. We'll gather all those questions. Hope to answer one of your questions on our next mailbag segment next week. Also, as a reminder, go to StockChartsTV.com. Use your email, set up a free account. You can watch all of our content immediately from the website, also from all your mobile devices. Just search on the app stores for StockCharts TV on demand. Let's continue on with today's show, answering your questions from the Final Bar Mailbag. As I mentioned, one of my favorite parts of the show is hearing from you guys and helping address questions that are coming up in your own process. Nothing is out of bounds, and let's get to the first question now. Let's see. Boy, this is a meaty question, so I'm going to summarize as much as I can. Basically, talking about the seasonality charts on stock charts. I'll bring up, let's see, something like XLF. It would help if I switch to a seasonality chart, which I will do here at the bottom. So basically what happens when you bring up the seasonality chart, we're going to back it up to about 20 years, and you can see what months, what's the batting average per month. This is basically telling you January, February, March, April, what percent of the time you close higher than you open. So it's basically a seasonal trend looking at different months. What's interesting about the financial sector, on a day like today, financials have popped a little bit. It's only about a third of the time in the month of June, going back 20 years. So basically since the 2002 market low, the financials have actually finished the month of June higher than where they started. It's interesting because the sector as a whole has pulled back a bit, right? It's you've seen some pullback in some of these names, but it's interesting. Stocks like Moody's, MCO, sort of breaking to new highs this week, but we digress. Your question in particular was, can we scan on seasonality trends and probabilities, average gain during a given month? And you were looking at SPHB, the high beta ETF, versus the Qs, QQQ, and looking at their potential moves. So the short answer is no. There's no great way to scan on seasonality. These engines are actually very different. You were actually looking at the Qs, and you were saying that in the month of July, Qs are up 100% of the time. You're absolutely right. That's going back to the last 5 years. If we take it back 20 years, you'll see it's actually pretty good. 4 out of 5 times. Going back to the last 20 years, the month of July is a positive one. We're coming off of June, which tends to be a weaker period. And if you look, you find a lot of these sectors, a lot of these indexes, June, August, September tend to be pretty weak, even October, and then you'll see them start to improve going into year end. So, is there a way to scan on probability? There really isn't. That's a really good idea. It's not one that I've looked at a ton. But I sort of get the argument for it. We're on the list. We have a development list that we are actually in the midst of pouring through, and our development team is digging into to think about the rest of this year and where we're going to focus. The scan engine is top of mind, I know, for many of us that are power users of StockCharts.com. It's a very powerful tool right now. Allows you to find ideas. It can be better, and I think incorporating the seasonal trends in there will be very, very cool. So thanks for that suggestion. There is no great way to do that at the moment. You really have to look at them individually, but I encourage you, if you've not experimented with the seasonality charts, give it a shot. At the top where it says Sharp Chart, switch it to seasonality, and then you can type in different symbols. You can actually also compare 2 symbols to look at their relative performance by seasonal trend. Next question is another, you guys are sending meaty questions recently, wordy questions. I'm going to summarize. Basically, is this a bullish chart for stocks? And you sent this chart along with you. So very quickly, this is the McClellan Oscillator, the $ NYMO. We have a ratio adjusted McClellan Oscillator, which is what you're showing me. And I'm guessing by the fact that you're saying turning positive, it's because the stochastics of the McClellan Oscillator have gone negative and have turned back positive. And that looks like what you're indicating here, because you're highlighting with the green bars other times where that has happened. And then with the red, you're showing when the stochastics is giving a sell signal. So yes, if you're using this as your toolkit, absolutely. I mean, this would be a buy signal by that. My real question is that a legitimate buy signal from my interpretation? I don't look at it that way, but I do look at the McClellan Oscillator a little differently. Let me show you. Nope, that's the right way. Let's see, McClellan Oscillator. Here we go. I was going to say my chart's in here somewhere. Yeah, I tend to look at it a lot more simplistically, and I totally get the argument. You're basically trying to identify when it's very weak and turning positive. That's what you're doing with the stochastics. I don't mind that. For me, I tend to use it very simple, and I just say, is it above 0 or below 0? Above 0 is bullish, below 0 is bearish. You have much more of a system that most likely would test better than my own. I'll make a note to take a look at that a little more deeply. But by my read, it's not quite turning more positive, and again, having the McClellan Oscillator above 0. The problem is during this period, you can see that the market obviously has been in a long-term uptrend. Excuse me, but the McClellan Oscillator has turned back and forth above and below 0 during that time. So it's actually a choppy indicator. The McClellan Summation Index, a lot of people use as a better read of the long-term trend for those of you who are interested. But I like your chart. I agree with your interpretation. Next question, you mentioned you have institutional experience. So what happens when the quote unquote big guys in that room decide to sell? I'm very good at selling low and buying high, but I'm curious when a level is violated to the downside or a target. Do they look at a weekly close, hourly, minute candle? Right, and I get so confused when stock experts say close above this level, I'm in, or close below, I'm selling everything. Yeah, really good question. So I think you've hit on a number of different things, and I would say, the reality is most institutional investors, and now again, you're grouping all institutional investors, all money, all big investors as one big group. And you have to remember there are a lot of different types of firms and a lot of different types of investing that can be done, and all sort of be bucketed as institutional investing, right? You could argue a pension fund, which is basically the definition of slow. It's like the Titanic, kind of navigating through asset allocation and really just keeping things relatively stable and focusing on trend following, or a hedge fund, and you're swing trading, you're looking at more compressed timeframes and everything. So I think who you're actually talking about would mean a lot of different things. When you're talking about the big guys in the room, I tend to think of more big money managers who are running a large amount of assets. They're not super nimble, is how I would describe it. So it tends to be longer term charts, longer term timeframes, and more sluggish movements between assets. And what I mean is, right, when you're at a large mutual fund company, you can't be nimble, right? Because if you're taking a position in a $50 billion fund, you can't just buy some Disney and put it in the fund. Like, you slowly have to accumulate a position in a stock like Disney over days, if not weeks, because it takes so long to actually put that into play and not completely shock the system and ruin the supply and demand equation by dumping in a bunch of orders. And so part of what you need to do is spread out those trades over time. So, what is it when you decide to sell? I would say in general, money managers are trend followers, meaning you are going to buy when things are going higher. And so you're much more likely to buy breakouts. Now, I'm generalizing as trend followers and growth managers. There are plenty of value-oriented managers that would much more buy a falling knife by weakness and try to buy low. But on average, the money managers that I've worked with are more growth-oriented, and they tend to be looking at long-term trends, so they're more likely to buy new highs than new lows. So you stop buying, or you would start to take profits when things stop going up. And it's not a price target. It's not saying when the S&P hits 5,000, I'm out, because if it got to 5,000, it could easily go to 8,000, right? I mean, the idea is to follow the trends until the trend is no longer going higher. And so that's why we focus a lot on this show. And if you look at what I write and what I put videos out about, it's a lot about trend following. It's a lot about when a trend is no longer up. So an example of a trend, I think, that has turned lower, if you want to get a sense of what that might look like. Two come to mind. ConAgra Foods, CAG, is one. Southwest Airlines, LUV, is another one. This is a stock that has been in an uptrend, but is broken down and is breaking down through support levels, breaking down through moving averages. The relative strength especially is going down. We're out of time, but the last thing I would mention is one thing pretty much any institutional investor I've ever worked with has been focused on is relative strength, because that is most importantly how you're paid. You're paid to own stocks where that line is going up. And so that is your report card. That's your living report card on the chart. That's why we would always look at the relative strength line. If that chart's going up, you're doing your job and you're outperforming. Great questions, by the way. I took a little bit more time answering some of those, but I hope it helped illuminate some of those things you were asking about. And thanks again so much, those of you that sent those in. We need to take a quick, we need to wrap the show. We're done. The 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P breadth by cap tiers. We looked at this in our Wrap the Week segment. This is a chart we've referred to regularly over time. When I'm looking at this market, the most bullish thing the market can do is go up. That's what Paul Montgomery, a legendary technical analyst, always used to say and write. And I agree. I mean, if you look at nothing else, the S&P is making new all-time highs. That can't be a bad thing. So I'm always looking for indications that may not persist. And one area of concern I have is with breadth. While some breadth measures are positive, we saw the McClellan Oscillator, certainly not negative and very close, depending on what you use, as turning positive. When I'm looking at the cumulative advanced decline lines, I can't help but notice that the market has been going higher. The market has made new highs this week, but the cumulative advanced decline lines have not yet confirmed that. I think it's worth looking at this set of charts going into next week and see if you do get a follow through to the upside and you get those advanced decline lines making new highs, confirming new highs. That would certainly be encouraging. Chart number 2 are the 3 sectors making new highs this week. And I didn't look right at the close. I believe this is still the case, but out of the 11 S&P sectors, I only counted 3 of the 11 that also made new highs. So it's actually another interesting thing when I think about sector breadth. The S&P making new all-time highs, the NASDAQ 100 making new all-time highs, but only 3 of the 11 S&P sectors also making new all-time highs. What are they? 2, you'd probably guess, technology and communication services, both of which are pretty heavy weightings in the NASDAQ. But then healthcare is number 3. So if you've been ignoring healthcare, ignoring charts like Regeneron and biotech, some of the pharma stocks like Moderna that are breaking up pretty well, I would take another look at that sector. Finally, the chart of gold, and I just want to highlight that after gapping lower last week, 6 of these 7 sessions, we have closed at or near the lows of the day. That is not an encouraging sign for gold. I feel like that is heavier rather than lighter. I'm a little concerned about the ability to gold to hold up next week, and I'll be looking at last week's low around 165 on the GLDS support. Folks, that is our show, and that is a wrap for this week on the Final Bar. Thank you so much for joining us every weekday after the close. We'll see you on Monday, but until then, have a fantastic weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.